Hi, I'm Carly Zakin, co-founder and co-CEO of The Skim. Danielle, our other co-founder and co-CEO, is taking this semester off while she's out on paid family leave. But from the both of us, welcome back to class. Meet SkimmU Money, a series of courses to help you start investing and build long-term wealth. When we started The Skim, investing in ourselves was honestly the easy part, but there wasn't much room in our budget for saving for a down payment or life's unexpected moments. And that's where financial planning comes in. We learned that investing doesn't mean saying, see you later to your money until retirement. A CD and other methods of investing can help save money with short-term goals in mind. Your not-so-future self will say thank you. Bola Sokunbi is an author and the founder and CEO of Clever Girl Finance. She'll show you how to invest for life's big moments without losing sight of your short-term goals. Class is in session.
Hi, everyone, and welcome back to SkimmU Money. I'm Alex Carr, the senior producer and host of the Skim This podcast, and I'll be moderating our conversation tonight presented by Fidelity. Last night, we learned all about the ins and outs of saving for retirement. And tonight, we'll teach you how to invest with your short-term goals in mind. That could be anything from saving for a down payment to starting a business to financing your dream wedding. Here to help with that is Bola Sokunbi, a certified financial education instructor, finance expert, and founder of Clever Girl Finance. After Bola finishes her presentation, we'll welcome Mabel Nuñez, the founder and chief education officer of Girls on the Money, a stock market investing education company, to join the conversation. And we'll end the evening with audience Q&A. So if you have questions for Mabel or Bola, you can submit them anytime using the tool on the side of your screen. And tomorrow, you'll receive an email with a link to this session, so you can rewatch it, bookmark it, or share it with a friend. So let's go ahead and bring in Bola to get started. Bola, welcome to SkimmU. Thank you for being here.
Thanks for having me. I'm excited to teach this class. So when you hear about investing, you typically hear about it in the context of the long term. However, if you have short-term goals like buying a first home, for example, then short-term investments are a great way to help your money grow while remaining liquid, especially given that traditional savings accounts don't have the best interest rate. So in this course, Investing for Later-ish, you'll learn just how short-term investments work and ideas of short-term investments that you can consider as you lay out your goals. So grab your pen and your notebook and let's get into it. So we're gonna cover specifically how short-term investments can help you reach your different financial goals, the different types of short-term investments, their pros and cons, and when to use them, and what you need to know about investing versus day trading. So let's start out with what short-term investments are. And what are short-term investments? Well, they are investments that you can easily convert to cash if you need to. And they're investments that you make when you need the money in 5 years or less. So short-term investments are different from long-term investments, which are investments that are typically 10 plus years into the future. So for example, a long-term investment could be saving for retirement or saving for a child's college education. And so you're probably wondering, well, when can I use short-term investments? And there are a variety of different scenarios in which you can use a short-term investment. For example, you could use them for a down payment if you're trying to buy your first home, for a wedding, to start or expand your family, to move, to build an emergency fund, which is for unplanned expenses when life just happens, or even for a sinking fund, which is for your planned upcoming expenses. For example, planning a vacation, new tires, or even a new roof on your first home. And you can also use short-term investments to start a business. And this is how I first started my own business, Clever Girl Finance. I leveraged online savings accounts and certificates of deposits, which we'll talk about more in this course. And I built my investment deposits into my budget for an 18-month time period to get my business launched. So there's a variety of different scenarios in which leveraging short-term investments can make sense for you. With that said, let's talk about some of the benefits of short-term investments. First off, short-term investments can offer you with an opportunity to grow your money over a short period of time. And this can happen through the power of compounding. And compounding is when your money earns interest, and that money and interest continue to earn additional interest over time. So rather than having cash sitting in a checking account not earning any interest at all, with stable short-term investments, your money is growing for you and earning compound interest. And short-term investments can also be hedges against inflation. This means that you have the opportunity to retain as much of your money's value as possible, given the average inflation rate of about 2% a year. And by inflation rate, I mean the rate of decline of the value of the dollar. So let's get into a specific example of how a short-term investment, how you could leverage a short-term investment. So let's say you want to buy your first home in 3 years, and the budget for this first home is $200,000. You get a first-time home buyer's loan, for example, an FHA loan, Federal Housing Administration loan, and this loan requires a down payment of 3.5% or $7,000. So you know how much you need to save for your down payment. Then you can decide on a short-term investment and then build your investment deposits into your budget, broken down into weekly, bi-weekly, or monthly deposits in order to meet that $7,000 savings goal that you've given yourself over that three-year time period. So essentially, leveraging a short-term investment vehicle will help you retain the value of and grow your money versus keeping it in a traditional savings account where it's earning little to no interest. With all of that said, let's talk specifically about some of the different types of short-term investments. Side hustles, which I'm a big fan of, online savings accounts, which you've probably heard of, you probably have, money market accounts, short-term bond funds, certificates of deposits, also known as CDs, and peer-to-peer loans, also known as P2P. And for each of these types of short-term investments, I'm going to go over pros and cons and also suggest timelines of when they can make sense for you. So let's start out with online savings accounts. They are easy to open. You can open them pretty much at any time. They're low cost. They're highly liquid. You can access your money at any time as well. And they're insured by the Federal Deposit Insurance Corporation, also known as FDIC. And this is a U.S. government-backed insurance that protects your deposits up to $250,000 against loss in the event that an FDIC-insured bank or institution fails. The con to online savings accounts is that they may not beat inflation and may offer low returns. The next type of short-term investment is money market accounts. And money market accounts are designed to be investing fund holding accounts. And I personally use this account type for saving for emergencies, for my emergency fund, and for money I plan on investing. They are safe. They're also highly liquid. You can access your money anytime. And however, when it comes to cons, they may have fees associated to them, and inflation can take away from your profits. However, if you're saving for a goal in 1 to 3 years, then leveraging an online savings account or a money market account could be a good idea. And you can open these accounts at financial institutions. You could open a money market account at a financial institution that offers brokerage services, for example, Fidelity. Next up are short-term bond funds. And short-term bond funds is essentially their money that you loan to the government or to corporations at a guaranteed rate of return. You know how much you're going to earn when you make that investment. They are liquid and have higher returns than your traditional savings account and than money market accounts. However, when you compare them to other long-term investments, they may offer lower returns. If you have a savings goal in the next 1 to 4 years, using a bond fund as a short-term investment could be a good idea. And you can open bond funds at financial institutions that offer brokerage services, or you can buy government bonds at treasurydirect.gov. Next up are certificates of deposit, also known as CDs, and you may have likely seen this offering or been offered this at your traditional brick and mortar bank if you have one. They are similar to savings accounts, but they are based on a fixed period of time at a locked-in interest rate. They are typically safe, they offer various options in terms of timeframes, and they do offer better returns and fixed rates, so you know how much you're going to earn compared to your savings accounts. It's important to keep in mind that when it comes to CDs, if you withdraw your money early, you can face penalties. And again, it can also offer lower returns than other investments, for example, when you compare them to stocks or funds. If you're saving for a goal in the next 3 months to 5 years, using a CD as a short-term investment could be a good idea for you. And you can open a CD at an online bank, at community banks, and also at credit unions. Next, let's talk about peer-to-peer loans, also known as P2P loans. And this is when you lend money to pre-vetted individuals through online P2P marketplaces. There is a possibility for high returns based on the interest rate at which the money is lent to that pre-vetted individual. However, they can be risky and subject to fees, and the returns can be unreliable, especially if whoever you've loaned the money to is unable to pay. If you have a higher risk tolerance and you have a goal that you're saving for within 1 to 5 years, this could be a short-term investment that you could consider, keeping the fact that it's a little higher risk in mind. And you can open or offer a P2P loan at online P2P lenders in online P2P lender marketplaces. And then let's talk about side hustles. Side hustles are an opportunity to earn extra income based on your skills or your talents. And you can start a side hustle based on your passion or interest, on a skill you're good at, or something that you get complimented on often. So I started my own business with a side hustle, and I leveraged it as a short-term investment when my business started making money. And so when it comes to cons for side hustles, it's important to keep in mind that you want to give yourself time to build the business, to get it on its feet so that you can start to monetize it. So if you're saving for a goal in 2 to 5 years, a side hustle could be a good short-term investment for you. And as I mentioned, give yourself time to get it on its feet. And as I mentioned as well, you can start it based on a passion, on an interest, a skill set. What matters is that you start. So get your website going, get your social media accounts going, and start to offer your products and services so you can start to monetize your business and start to save that money. So now that we've talked about the different types of short-term investments, let's talk about investment interest rates. And interest rates for savings accounts, bonds, and CDs are typically dependent on federal interest rates set by the Federal Reserve based on economic trends, for example, inflation. And you probably heard about the Federal Reserve rate hike today. We'll talk about that in a little bit. And also, interest rates can be dependent on the initial deposit amount you're able to make into your short-term investment. As you are considering what short-term investment might work for you, it's really important that you always do your research for any investment, not just short-term investments, but it's important that you do your research and you compare rates across the different types of short-term investments before you invest. You can do your research online by using online comparison platforms to see what the current rates are across multiple banks, or you can look up your banks of choice on your own and compare interest rates on the bank's website. So as I mentioned, it's in the news today, there was a federal interest rate hike. And as of today, September 21st, federal interest rates are between 3% to 3.25%, again, raised today. It is key to know that banks determine what rate they will offer in correspondence to federal interest rates, and this can be changed at the bank's will. So prior to today's announcement on the federal rate change, bank rates for high interest savings accounts were between 1.6% and 1.85%. And this interest rate may change based on the announcement today. So if you do some research over the next few days or weeks, you may see that banks are raising their rates as well. It's important to keep in mind that when you compare your high online interest savings accounts to your average bank savings rates, the interest rate is much lower for those traditional average bank accounts, and the average is around 0.13%. The interest rate that you earn on your short-term investments determines how much you can earn in interest on your deposits when they're compounded daily, monthly, quarterly, or annually, depending on the account that you have and the financial institution. And so basically what all of this means is that the higher the interest rate on your account, the higher the return on your short-term investment, and that's good for you. So now that we've talked about interest rates, we've talked about the different types of short-term investments, a very common question is, what about day trading and cryptocurrency as short-term investments? Well, you have likely seen tons of meme stock posts on social media discussing trending stocks and different investments, suggesting trading and cryptocurrency can make quick and big returns. But is it right for you? Well, let's talk about it. So when it comes to day trading specifically, before you quit your day your day job, let's talk about what day trading requires, right? First of all, it requires dedicated time and consistency. So I wouldn't recommend day trading unless you have plenty of time to dedicate to tracking your investments on a daily basis and sometimes even multiple times a day. Day trading also requires a specific skill set. This means understanding how to do research on investments and understanding investment data before you can confidently participate in this type of investment strategy. And when it comes to day trading, it's also really important that you understand the fundamentals of the stock market. So these are some key things that you want to keep in mind before you say, you know what, I'm just going to go full-time day trading. When you think about, well, what's the difference between investing versus day trading? Well, investing focuses on value and growth over time, right? It is long-term, whereas day trading focuses on short-term returns, which means that day trading involves frequently buying and selling stocks over the short term. So for example, over the course of a day, you may buy and sell it multiple times or over the course of a week. And the goal is to generate returns that exceed the purchase price of the initial investment that you made. And profits are made by buying investments at a lower price and then selling them at a higher price over that short period of time as a result. This type of investing can be very volatile due to automated trading programs, algorithms, and also due to buyer-seller rationale, demand, and trends. So that's what you want to keep in mind when you're asking yourself what's the difference between investing and day trading. Next, let's talk about the cryptocurrency aspect of it. So cryptocurrency and other digital assets. They are essentially virtual or digital money, and there is no defined regulation by a government, currency system, or banking system, right? So cryptocurrency and these other digital assets that you hear about, for example, NFTs, they are decentralized assets, which means that they are not controlled by any traditional financial institution, a banking system, a currency system, or a government. And as a result of this non-definition as a result of this no defined regulation, it can be high risk, which means it can be volatile and also speculative. It's also important to keep in mind that when it comes to the value of these digital assets and cryptocurrency, the availability is based on supply and demand. And this is tied to the associated value and what people are willing to pay for it at a given time, right? And so because it's based on supply and demand, it can also generate high returns. So bottom line, is investing in cryptocurrency a good idea? Well, cryptocurrency is still a fairly new investment category when you compare it to the stock market. However, it can be a worthwhile investment because of its potential to grow in value as it becomes more widely used and as a mainstream form of payment. You may notice on certain online platforms, they're offering cryptocurrency as a payment method. So it definitely is something that has a lot of potential over the long term. However, it's very important that you have broad diversification in your existing portfolio in more stable assets before you invest in cryptocurrency because of its high risk and because of its volatility. So as you think about day trading, if you're interested in that, or as you think about cryptocurrency, if you're interested in that as well, you want to consider these different points I just mentioned to determine if it is a good match for you. And very, very importantly, make sure that you have diversification in your portfolio. And so when it comes to short-term investments, there are a few things that you want to keep in mind. Short-term investments are great options for anyone who's looking for liquid and stable ways to grow their wealth over the short term, so under 5 years, right? There are lots of choices, which I just went over. There are money market accounts, peer-to-peer lending, certificates of deposit, and even bonds. So it's basically you determining what's going to work best for you by assessing your goals, assessing your risk tolerance, and then making the decision on that short-term investment that's right for you and also for your money. So I hope you guys have enjoyed tuning into this course, and you can keep up with me at Clever Girl Finance on all social media platforms.
Thank you. Thank you so much, Bola. I don't think I'm going to be pursuing day trading anytime soon, but definitely good to know about. I want to go ahead and invite Mabel, the founder and chief education officer of Girls on the Money, to join our conversation. And remember, we'll wrap up tonight's event with an audience Q&A. So if you have questions, submit them using the tool on the side of your screen.
What's your ghost? The ghost of you, it keeps me awake. My friends had you figured out. Yeah, there's so what's inside of you. You tried hiding another you, but you're
Mabel, thank you so much for joining us.
Thank you for having me. Excited to be here. Great job, Bola. I loved it.
Thank you.
Bola, a few follow-ups based on your presentation. I think the first one is, if you had to rank those 6 options for short-term investments you gave us from like least risky to most risky, which, kind of what is the lowest risk, maybe lowest reward, and the highest risk, highest reward?
So lowest risk would be your online savings account, certificate of deposits, your money market account after those 2. And then highest risk would be definitely the peer-to-peer lending.
Absolutely. And you mentioned the importance of being liquid in your presentation. And I just want to break that down and understand what actually is being liquid.
So being liquid is having access to your money, right? So when you're invested in the stock market or you're invested in real estate, you have to take an action to list your home and sell it or cash your stocks out by putting a transaction. But being liquid is being able to easily access your cash. And that's very important, especially during uncertain times. You want to have that cash buffer, for example, in the form of an emergency fund that you can just get to without having to sell anything when you need it.
And Mabel, a question we get a lot is, how much money do I need in my emergency fund? And I'm curious what your advice is around that.
Sure, it's a very important question, and something that a lot of people ask. So I would say it depends on your personal life situation. Somebody that with a mortgage and kids might need a bigger emergency fund versus somebody that's single and doesn't have a lot of responsibilities. So I would say a great way to get started is just figure out how much you spend every month and multiply that amount by 3 or 6, depending on whether a 3-month emergency fund or a 6-month emergency fund will make you feel more comfortable, and start from there. Obviously, the more you have, the better, but you have to start somewhere. So people get overwhelmed by that goal.
And would you advise someone to think about having more in their emergency fund, let's say if they're in a certain type of profession, like if they work on commission or in certain types of industries? And then for people who have kids, should they just multiply their emergency fund by the number of kids they have? Like, how does that work?
That's a great point. Somebody with an inconsistent income obviously will make more sense to have a little bit more saved versus somebody that gets a salary every 2 weeks. Somebody with kids needs more money. It's expensive to have children. So, that would also add on to the total amount that you will need.
Yeah, and if you have an inconsistent income, one thing you can do is during those months where you are earning money or earning higher than normal income, be intentional about putting money in your emergency savings, because you know that a slow period is coming because maybe you're working on commission or in consulting, for example. And then if you have kids, sit down and determine what are your child's expenses, right? Daycare, activities, clothes, what are those expenses? And then average them over 3 to 6 months, as Mabel said, to determine how much extra you need to save on top of what you're saving for yourself.
That's a really good point. And one of the questions we also got was around how liquid you should be based on certain kinds of short-term investment goals you're trying to reach, like buying a house or having a family. And what advice do you give around that?
So I would definitely say that when you have that short-term goal, which is under 5 years, you want to keep your cash liquid, which means you don't want it tied to any real estate, and you definitely don't want it tied to short-term stock market volatility. So going back to those examples of types of short-term investment funds, you can put this money in an online savings account, a money market account, a CD, a short-term bond fund, but you want to be able to easily access this money when your date comes, when you want to accomplish that goal in the short term.
And Bola, can you also help us understand how we can set short-term investment goals that can weather the economic volatility that we're seeing right now?
Yeah, so it's all over the news what's happening in the economy. And when it comes to your short-term investments, weathering uncertainty, it's important to lean more conservative, right? Know that you're going to get a certain rate of return and you can plan your goals accordingly. So again, an online savings account is a good conservative investment, a certificate of deposit, a government bond because it's at a guaranteed rate of return. You want to look more at those short-term investments that are minimal risk and more conservative so that you can forecast that in 2 years, in 3 years, when I want to buy my house, plan my wedding, etc., I'm going to have this exact amount of money there without worrying about, oh, is my account going to swing with the stock market changes?
Yeah, I would agree with you, Bola. Yeah, definitely don't. If you have a goal within the next 5 years or less, definitely don't put that money in the stock market. The stock market is very volatile. We've seen it. This whole year, 2022, has been quite crazy for the market. So if you had you don't want to have that money just tied up in stocks and funds. But if like more short term, definitely savings accounts and bonds and stuff like that. You should stick to that.
And would you recommend someone delay certain goals based on economic conditions?
I would say no, just because you cannot time the market. We cannot predict whether things are going to start getting better in 6 months, in a year, next month, who knows? I would say unless you have money already in the markets being invested for a specific goal that you had originally, maybe that you planned for a few years back, maybe in that circumstance you do have to wait it out and change your strategy a little bit. But if you haven't started saving for that short-term goal, then don't tie it up into markets.
Yeah, I agree. You don't want to get into the business of timing the market. Determine what it is you want to accomplish for yourself with your finances, and then act accordingly. How much do you need to save? Okay, things change with the economy, with your job, then readjust your goals, but don't not do anything because you're getting overwhelmed by the news and what's happening in the economy. Plan accordingly and then take action.
And you mentioned this in your presentation, but it seems like high interest rates in certain situations can actually benefit some short-term investments. Can you talk a little bit about that, or did I not understand that right?
No, you did. So when the Federal Reserve increases rates, rates go up across the board. So they go up on savings accounts, on money market accounts, on certificates of deposits based on the bank's decision. And they also go up on things like debt, like loans, mortgages, credit cards. So it is a benefit to you when Feds raise rates. When it comes to your savings, right, you can definitely take advantage of one of those short-term investments to save more money and take advantage of the higher interest rates. However, if you have high debt, especially a credit card or a debt that's associated to variable interest where the rate will go up as the Feds have made that decision today, then it might be worthwhile to focus on paying that debt down while you still save a little bit for emergencies, because that in itself, paying down that debt is a good investment because eventually you free up more money that you can put more aggressively towards your goals.
Yes, I agree. Yeah, most people, when they think about short-term investments, they're thinking, savings accounts and bonds, which is the bulk of it, but definitely paying down your debt is part of that equation too. So consider if you have a lot of consumer debt, specifically credit cards, a smart strategy would be to start paying that down, and that's like paying yourself back all that interest, whether it's 20%, 18%, whatever your credit card rate is right now. So,
and if someone is trying to build that emergency fund that we talked about, and they're trying to become more liquid, but they're also wanting to start their short-term investment planning, how would you advise them to think about that balance?
I would say it's very possible to do both, and I would recommend it. That's how when I started my investing journey, I was also building my emergency fund at the same time. So I guess a good strategy would be, let's say, figure out how much money you have left over at the end of the month, maybe lower your expenses, find a way to have money left over, because a lot of people maybe feel that they don't have anything left at the end of each month. And then from that, maybe allocate 60% towards an emergency fund, which is very important to have money that's liquid, and then maybe 40% of that towards saving towards your investments.
Yeah, so I definitely agree with you, and just be intentional about it, right? Build it into your budget. You want to save for emergencies. You want to invest. Be intentional. Have line items in your budgets for each of these things, and then determine where you can cut back, and also think about how you can earn more. Are there things in your closet that you can sell, your kitchen, your garage, that you can put towards emergency savings or your short-term investments? Can you get a part-time job? Can you ask for a raise? Start looking for a better paying job. Get creative to be able to fund these goals that you have.
Something that's kind of wreaked havoc on a lot of our budgets is inflation. And I want to understand how inflation can impact how we think about short-term investing.
So the inflation has been in the news a lot recently because it's just been high. But the truth is that inflation has always been here, right? We can all tell a story from our parents or our grandparents about how cheaper milk and bread and eggs were back in their day. So inflation is essentially ongoing. It's on average 2% a year. During the course of the pandemic, it was up at around 6 to 7% just because of what was going on. But it's essentially the decline in the value of the currency. So in our case, the dollar. So when you think about short-term investments, at a very minimum, your goal is to retain the value of your dollar as inflation happens and continues to go on as each year comes. So that's why I mentioned in the presentation doing your research to compare rates and going for the highest rates, and also thinking about your risk as you pursue these short-term investments, because you don't want your short-term investment to be tied into volatility, but at the same time you want to retain its value as inflation is going up. So the key when it comes to short-term investments and inflation is how can I retain my value leveraging a short-term investment?
And Mabel, how are you thinking about the best way to navigate the market and broader macroeconomic conditions right now?
Okay, I would say just keep in mind that there's no way, like we said earlier, to predict the market or what the market will do anytime soon. If we knew that information, we'll all be billionaires. There's no way to predict that. So just if you have short-term goals that we've been emphasizing, just stick to the bonds, the savings accounts, the money market accounts. Stick to that. Don't try to gamble your way into the market trying to accelerate your savings for that goal that you have, because more often than not, there's going to be a mistake. Might end up losing a lot of money, and you're going to get even more backtracked. So just understand that we don't know what's going to happen next. So if you do have goals that are maybe 7+ years ahead of you, and you want to take advantage of the amazing sale that we're having in the markets right now in terms of excellent funds and stocks on sale, quote unquote, then this is the time to do it 100%, but not if you have a shorter term goal.
Yeah, I checked my 401k recently. That was interesting. Just hopefully, it goes back up. I'm sure it will. Bola, we talked about retirement yesterday in SkimmU yesterday, and how basically that's like a set and forget strategy for a lot of people. What are the differences between managing your short-term investment portfolios and your long-term investment portfolios?
Yeah, so like you said, your long-term investment portfolios are out into the future. So to a degree, it's set and forget it. But obviously, as you get closer to your long-term timeline, retirement, kids' college savings, you want to start readjusting your portfolio balance so that you're able to leverage that money for your immediate needs at that time, right? So your first 2 years of retirement, first 5 years of retirement, while you leave the rest invested. Whereas with your short-term goals, it's for an event or goal that is in less than 5 years, as I mentioned earlier. So your goal really is to make sure that you have that amount of money that you plan to have next year in 6 months and 12 months so that you can actually complete this goal. So those are the main differences between the two, right? So when it comes to short-term investments, again, leaning more conservative. When you invest long-term, your money has time to weather the storms, the volatility in the market, to appreciate, to compound, and all of that. But with short-term investments, there may not be enough window of time for your money to recover with volatility. So again, bottom line is short-term investment, you want to retain, at the minimum, retain the value of your money so that you can complete your goal at your timeline.
And Mabel, how do you know if hiring a financial advisor is the right move when it comes to keeping track of and managing your short-term investments?
Okay, so my personal opinion is that I don't feel that you need a financial advisor to help you with your short-term goals, just because things like bonds and savings accounts are considered safer, so your money is not really at risk. It's more liquid, as Bola had mentioned in her presentation. So I don't think you need a financial advisor to just allocate your money in that way, unless you have an extreme circumstance where you feel that your specific goal is more difficult or more challenging than the average goal, then maybe in that circumstance. But for the average goals, the average person, I don't think that's necessary. It's extra cost. You got to think about, you have to pay them. They're going to take either a percentage of your money right off the top, whether they do well or not. So you got to keep those things in mind.
And Bola, I think everyone likes to know, how often should I be checking my investments? Because it sounds like you can go crazy checking every day, but what do you recommend for short-term investments?
You can certainly lose your mind checking your investments, especially with every news announcement of what's happening in the economy, globally, et cetera. So long-term investments, give yourself grace, give yourself a break. You don't have to be on it every time you hear something on CNN or wherever, whatever channel you watch. Short-term investments, the good thing about short-term investments is that for a lot of the examples I mentioned, you can kind of determine what you're going to earn with a little bit of math, because a lot of the interest rates are stable, right? Bonds, a guaranteed rate. Online savings accounts and money market accounts are tied to interest rates based on the bank's decisions, tied to Federal Reserve rates, which we just heard. So you kind of know that, okay, I'm going to get at least 1.XYZ, 2.XYZ, 3.XYZ based on what has been announced. So, I would say once a month just to check in to make sure that your deposits are happening as you expect, your transactions are happening, nothing is missing. But don't feel obligated to check every day. Don't stress yourself out. It is not necessary unless you're like giving yourself high fives. We're like, yeah, I saved. Then check every day.
Yeah, and should you do like an end of year check-in just to see how things are going?
Absolutely. I think it's very important because life happens. People's goals change. You may change your mind too about certain goals. So you always want to recalibrate at the end of the year and say, okay, what are my goals? is this what I still want to accomplish? Am I on track? Have I fallen off track? How can I adjust? I will say that when you do your end of year checkup, be very careful not to judge yourself or let other people judge you. We are all learning. The goal is to continue to make progress towards our goal. There is no perfection in goal achievement, and there's no prize for perfection. You know, you get it done. Nobody cares how you got done. So.
SkimmU, no one cares how you got it done. That's the name of this class. Bola and Mabel, thank you so much. I know our audience has a ton of questions about what we talked about tonight, so I do want to get to some of those. Our first question is from Sarah, and Mabel, I'll direct this one to you. Is there ever a scenario where you'd advise taking out a loan in order to keep your money in the markets, like taking out a student loan or a mortgage instead of cashing out your investments and taking penalties?
I would say it might depend on the interest rate that you're being asked for in that particular goal or circumstance. However, I am not a fan of cashing out money from any 401k or retirement accounts that does back you up when it comes to your retirement goals. So if you can avoid it, 100% I would say avoid it. But if you're in a situation where, okay, I have to take out this loan for 12% or something crazy versus taking out a small loan from my accounts temporarily, then maybe that could be an option. But I would not put that as my first thing, so.
Yeah. And we have another question from Sydney, who wants to know what kinds of accounts she can set up for short-term savings with low tax liability, Bola.
Yes, so when it comes to tax liability, it's important to keep in mind that when you are putting money in a short-term investment like a savings account, a money market account, you're going to pay, in any investment, you're going to pay taxes if your investment makes money. It just depends on the type of tax. So for savings accounts, et cetera, if your money earns money, then you're going to pay income tax, right? However, when you're investing in things like the stock market long term, then you would pay capital gains tax, which is much lower. So when you're thinking about minimizing your tax liability, looking more longer term stocks, right, because of capital gains, but online savings accounts, money market accounts, you're going to pay income tax. And I think, Mabel, you had a point about bonds.
Yeah, so most government bonds, for example, the Series I bonds, which you can research and look into in the Treasury Direct website that Bola mentioned in her presentation. For those bonds, you are exempt from state and local taxes, but you are responsible for federal taxes. So you can get a little tax break when it comes to government bonds, and there are safe securities there. For example, the one I just mentioned is tied to inflation. So you just have to keep an eye on how inflation is doing going forward, but that's a little tax break there.
The good news is that if you're earning money, that's a good thing. So
yes, that is true. If you're paying taxes,
wrong with that.
as long as you're not losing money and you're keeping up with that inflation or beating the inflation, hey, listen.
Yes, so true.
Our next question is from Julie, who's wondering if you can use short-term investments as a strategy to retire early. I don't know if she's talking about like GameStop or what, but Bola, what would you say?
So I would say that short-term investments, like I mentioned, money market accounts, online savings accounts, they tend to be more conservative, right? And it's really difficult to save your money to retirement because in order to get that initial investment, you're exchanging your time for income and you have a limited amount of time. And so when you're thinking about investing, retiring early, you want to invest to grow your money. And that means taking on a little bit more risk. Things like real estate, the stock market, small business is where you want to focus on, but it's going to be difficult to save your way to retirement without that extra investing boost.
Yeah, 100%. I feel that if you want to build wealth for retirement purposes, to have enough money for retirement, the stock market is a non-negotiable, or investing in funds and stocks is a non-negotiable. That's, the most efficient way to grow your money over time, not overnight, over time. So that's important. You cannot save your way. You cannot put money in a savings account and expect to just retire sooner, unless you win the lottery or you have a super high paying job or you're getting millions of dollars a year. That's a whole different scenario. But for the average person, then you have to invest.
Yeah, and one thing I wanted to mention that it's when you think about retiring, whether you retire early or you retire at 65 or you work beyond that, retirement is not a day, right? So the average retirement timeline for someone who retires at 65 is 20 to 25 years. That's a whole lifetime. So when you retire, you can still continue to invest and build your wealth, and you can still have short-term investments, right? So retirement is a whole other lifetime, so think about it that way. Yes, I can have short-term investments in retirement, but I can still continue to invest long-term for my future self.
Yeah, that's a good way to think about it. Our next question is from Jessica, who wants to know, Mabel, what are key indicators to look for in companies that can help predict steady growth?
Great question. So when you're looking, if you're looking at a specific company, for example, for to buy a stock for investing purposes, I would say two important metrics to look into are sales and net income. And that data you can find easily under the Investors Relations tab on any public company's website. So for example, a company like Costco or Walmart or companies that have been around for many, many years, you're going to find a lot of data on those companies, because you don't want to focus on one, okay, what were the sales for 2021? Who cares? You want to see 5-10 years worth of that data just to see trends over time and see if you notice growth. These are a little bit more difficult to examine or analyze when you're looking at startups or newer companies. There's not enough data out there to look at this information. That's why those investments are a lot riskier, and I would not recommend jumping into those, especially if you're not experienced with investing in the first place.
Yeah. And we have another question from Hayden. I love this question. Who wants to know if you have any online interest rate comparison tools?
Yeah, so a really, really popular tool is bankrate.com. They basically aggregate rates from online savings accounts, traditional brick and mortar banks, community banks, credit unions, and you can basically do your research there. But you don't have to leverage an online comparison tool. If there is a particular credit union that you are really interested in their values and what they have to offer and how they impact your community, then you can go on their website and look at their rates and then compare them to your traditional bank or other community banks or credit unions in the area to make a decision from there.
And Allie's wondering, can you explain the differences between money market accounts and mutual funds?
So money market accounts are more of a conservative, safer way to allocate your money. They're like you can think of it as a savings account. There's not really that much risk involved, if at all. When it comes to mutual funds, that's an actual investment in the stock market. So mutual funds are going to have stocks, different kinds of securities, different type of funds. So those are a lot more volatile, riskier. That's more of a long-term goal. Money market is more like a safer, put your money in the bank type of thing.
Yeah. So your holding account versus your actual investment. The money market account is the account where you put the money to invest, but it also gives you a return on allowing them to keep that money in that account for you, and that's in the form of interest.
I love that idea as a holding account for future investments potentially. Elise wants to know, can anyone use a P2P loan, or do you need to have a specific income or net worth? Bola?
I'm not entirely sure. I believe when it comes to P2P loans, as long as you meet the criteria to be able to offer the loan, you may need to have income. There might be a loan minimum where you can only lend starting from $1,000 or X amount of money. I don't think it's associated to net worth, but I do think that there are criteria to make sure that it's not a scam. So you may not be able to loan money from a credit card, for example. Instead, you may need to have actual cash linked to a checking account or savings account before you can offer it up to someone else as a loan.
And I would say look into who's asking to borrow that money, because if they have a low,
How do you look into them? Like, what does that mean? What does that entail? Do you just Google them?
Thank goodness for the internet. Yes. Bankrate also offers research on peer-to-peer loans and other online comparison platforms. There are a lot of scams. So, the first thing you want to do when it comes to P2P lending platforms is do a Google search, read the reviews, see what people are saying on social media. That's where you get the best insight to good or bad or horrific. Or scam.
Oh no.
Social media is good. It's good for something. Do the research. Do not just say, oh wow, peer-to-peer. No, do your research. That's like, if you remember anything from this presentation, do your research.
First and foremost.
And social media is good for something.
Yes, it's good for something. Research.
Yes.
We have a question from Caroline who wants to know, if she wants to buy a house within 3 to 5 years, Mabel, is it smart to invest in two to three short-term investments or stick to one?
You can diversify and do 2 or 3. Like if you want to do some bonds, some savings account, high yield savings account, absolutely. Be more careful with the peer-to-peer loans, are more on the riskier side of things. So I would say it's fine to diversify among different types of short-term investment. That might be the smart thing to do, as Bola said. Diversify is important. So yeah, why not? Yeah. I would say why not? And also they might offer different interest rates too and different levels of risk. So that could play into it.
Okay. And we have another question from Amanda who's wondering, Bola, what % of your income would you suggest keeping in a short-term investment account compared to longer-term investment accounts?
So That's dependent on the individual. I wouldn't say that there's a specific percent. It really depends on what you need to accomplish in the short term. So obviously you want to have an emergency savings, liquid short-term investments, 3 to 6 months of investment of savings. If you're able to extend it to 12 months of your core essentials, so that you want to keep it liquid. And then your goal, if you're saving for a home, saving to buy a car, saving to start a business, that you want to keep liquid. And what percentage that is of your income is really dependent on how much the cost of that goal is. So if you're trying to come up with a percentage, what you can do is determine the cost of your goal, how much emergency fund you need, and then take it as a percentage of your current income so that you have that sense of, okay, every month of each paycheck I get, or every 2 weeks, however you get paid, this is the percent I need to take and put into savings and short-term investments.
Okay, I like that. Chelsea's question is, I've heard that having a Roth IRA can be helpful for short-term savings and not only for retirement. Mabel, what do you think about that?
I could see her point per se. So Roth IRA offers a little bit more flexibility when it comes to retirement accounts. So the money that goes in is already taxed, and your money grows tax-free until you retire. So 59 and a half, you can take out all your earnings, all your profits, without paying any taxes. But some people use it as a short-term strategy where they allocate money towards the Roth and then take out their contributions if they need the money in the short term. That is a loophole. You can take out your contributions tax-free, but you cannot take out the money that's that you made as investments inside the Roth, because that brings penalties and taxes. It's a fine line because it is a retirement account, so you want to be careful. But some people do use it for short term.
Yeah, I would say that when you are investing in a Roth IRA, it is designated as a retirement vehicle, right? So that's investment for your future self, right? I don't love the idea of taking money out of the Roth IRA, even though you've already paid the taxes, because it's for your future self.
Exactly.
So there's that opportunity cost of you miss out on compounding, long-term appreciation, dividends. So I would say maybe leave that money alone and then build your short-term investments elsewhere.
Yeah, good advice.
I would agree, yeah.
We have another question from Carly, who's wondering, she's heard about I-bonds and that they're great right now, but are they too good to be true? How do you recommend approaching them? Bola, are you into I-bonds, not so into I-bonds?
Well, I think, not too good to be true, because I-bonds are typically higher when there is inflation. It's an incentive for you to retain value of your money and save more money. So I think it's important that you look at where the source of that idea of too good to be true is coming from, right? Again, a bond is when you lend money to a government or a corporation at a guaranteed return rate, and the government has never failed on paying the rate on bonds. However, when you start thinking about company bonds, corporation bonds, depending on how well that corporation is doing, it could be too good to be true. So you definitely want to do your research and lean towards, if you're new to investing in bonds, the government bonds.
I agree 100%. I will go with government bonds over like a corporate bond or anything like that. The current rate on the I-bonds, the series I-bonds, is 9.62%, I believe, which is extremely high. And it's like Bola said, it's backed by the government, so it's a very safe, investment, and it will get revisited again in November. So in November, the rate might go up again or stay the same. And again, in, I believe, May of every year. So May and November of every year, that's when the number gets looked at, and it gets either increases, stays the same, or decreases. And that depends on inflation. But I see nothing wrong with those bonds. They just keep in mind that you're not always going to get the 9.62%. That's going to change as inflation changes. So just keep an eye on that.
Yeah.
And we have one last question from Tina, who wants to know, is there ever a scenario where you should invest part of your emergency fund? If so, how much? What kind of investment? Or is that supposed to stay cash? Bola, what would you say?
So the whole point of emergency fund is that you have money when life happens. When life throws all of its lemons at you, you have the money to buy the blending machine to make the lemonade. So I do not recommend investing your emergency fund outside of money market, online savings account, certificate of deposit. You need to get to this money when you need it, and you don't want it tied to any volatility in real estate, in the stock market, in cryptocurrency. So keep your emergency fund liquid, and then designate other money towards other investments that you have in mind.
Yeah, 100%. I have no argument over that. Your emergency fund should be kept as an emergency fund. It should never be in the markets or invested in any meme stock or crypto or anything like speculative, because that's for emergencies. You need it just in case something happens. So,
And life always happens.
yes.
Life
so
happens. Thank you both so much for joining us tonight. I want to know, where can our audience keep following you? Bola, where can they find you?
Yes, you can find me at The Clever Girl Finance on all social media platforms and also on YouTube at Clever Girl Finance.
And Mabel?
Girls on the Money across all social media, Twitter, Instagram. It's just Girls on the Money, not once at the end, nothing like that. There's a lot of scammers on social media. Be careful, please. So just Girls on the Money, and then girlsonthemoney.com.
Awesome. Girls dollar sign on the money.
Oh my God.
It's a scam,
Be
people.
careful, yes.
Thank you all so much for joining us for tonight's course presented by Fidelity. Tune in tomorrow for our last class, Feeling the Crypto FOMO, starting at 7:30 p.m. Eastern. To sign up, head to theskim.com. I'll see you there.